Good morning. Thank you. Somebody gave me some feedback about the background not working. I think we're there now. That's great. So look, brilliant. Thanks for joining in today, everybody. My name's Darren Laverty. For those of you that have never seen me before, I'm from Second Sight, and a warm welcome to the last in the spring series of Financial Fitness Fridays. Now, we've been doing this for a year now. We've had great feedback. We've had literally thousands of people jumping on these sessions. And as you know, some of you know, we also, all the back catalogue does get put onto YouTube, onto a YouTube channel called Financial Fitness Fridays. So you can have a good look at those. And we've evolved it over time. You know, we stopped using slides at all now. It's all just conversation. It's like learning financial education through conversation rather than through a lecture. And the format, for those of you that don't know about it, the format for today is we run for half an hour. There's a hard stopper about half an hour. And I've got a special guest. I'm going to ask some questions to a special guest, a lovely lady called Caroline. And then after the half an hour, if you need to go, that's fine. If you don't need to rush off straight away, then what we'll be doing is answering questions. So throughout the session, if you pop your questions into the Q&A, that will be really useful. And if I see them pop up and I think they're relevant in the middle of it, I might bring them up. If not, then we work through some of those questions at the end. And, you know, if some of those questions are relevant for the group, that's great. Some of them end up being a bit individualized, and we'll pick those up by email later on. So the other thing we do need from you, please, at the end of the session, we're going to ask you to give us feedback. And we want to fine tune the experience to make it better and better. But the other thing we want to know is, what do you want to know more about? We want to decide whether or not to keep this going. As you know, obviously this is promoting our business because you've got the name Second Sight and Foster's and Ovo there, but we're not overtly selling anything. There's no product or service or software or investment at the end of this. It's just pure financial wisdom being shared, and I think in a unique and a pretty elegant way. So we do need your feedback. So all we ask in return for the session is give us it back, and we can then decide whether we're going to go ahead the next quarter into the summer and then again into the winter series. So today's topic is retirement planning. I've been in this industry. This is my 32nd year in this industry, and a lot of it has been focused around retirement planning. And the question that I get asked all the time, what's the best way to plan for retirement? Well, we're going to talk about pensions today. Absolutely. Pensions are a fantastic product. They used to be looked down upon in some ways because people thought the money died with them, but it doesn't have to be like that anymore. And I'm lucky enough, because I've been in this industry for so long, I'm still in touch with people that I advised to save, especially into pensions, going back 30 years. So I've actually seen the difference it can make by getting people to start these things early. And the best retirement really it comes from the people with the best habits, really is that. And it's about getting started, getting invested, and getting going early. There is one particular guy called Stuart. I'm still in touch with him, and I was 23, he was 19, and I encouraged him to save into his pension, and he was 19. By age 47, this guy's habits that I'd started at age 19, it meant that he was financially independent. And the guy was never a big earner. He was just an average earner. He just got into some very good habits very early on. And because he started at 19, if he'd have started at 29, if you look at, say, 7% growth on a pension pot, that 10 years wait would effectively have halved the pot. So he got in early. So that exponential growth at the back end is really powerful. If somebody started saving in their pension at 18, and they wanted to try and achieve the lifetime allowance into pensions, which is just over £1 million, they would need to save £140 a month from age 18, but most people get an employer matching arrangement. Most people also you get the tax relief. So really that works out for an 18-year-old about £50 or £60 a month. Doing that could actually make them a millionaire. But all these things are logic. And what I've learned about pensions and retirement planning is we can all have a good retirement if it's important enough. And that's the key thing. So this is logic. And there's lots of logic out there, like tax relief, matching contributions, spread the cost, low charges, good growth. But that is not enough to get us to take action, to do what's important. What makes the difference is us having a big enough why. Where does that why come from? Well, at the moment, we have day-to-day expenses, and the primary motivators in life are pain and pleasure. And we want to avoid pain as much as possible. And the pain we attach to the future, maybe 30, 40 years down the line of not having any money, is not very strong. But the pain of paying the bills today is. And so therefore, our priorities kind of be in the shorter term. If, however, we could play the movie of our life into the future a little bit, and we can see what we want, and we know what we want, and we can see there's a gap between our expectation and our reality, that's where the motivation comes from. It's that psychological journey we need to go on. So if you don't see the problem, then there's no motivation. So today's going to be a bit around, some of the technicalities, some of the mechanics of all of this, but also some of that psychology, some of that motivation. How do we get that good decision? How do we make those good emotional decisions first? Because without that, we don't get started. So without further ado, I'm going to introduce the lovely Caroline. Caroline, are you out there, please? Can you reveal yourself inside of it? So, thanks very much. Caroline is a financial planner with Foster De Novo and Second Sight. So, can I ask you the first question, which is the question everybody asks whenever I do a pension presentation? They all say, how much should I save into my pension?
Yeah, that is a question that I get asked a lot, and it's a really difficult question to answer because obviously everyone's vision of their retirement is different. You've got some people that have this dream of cruising around the world, and obviously going to require quite a big pension, and you've got other people that want to downsize their house and move to the coast. So it's a really difficult question to answer generically, but the first thing everyone needs to do is set themselves a target, because if you don't have a target, you're never going to reach the target. So it's about thinking about what you want your retirement to look like and setting yourself a target today. Even if retirement is a long way away, setting a target will just get those wheels in motion. So to set a target, you need to try and fast forward however many years it is and think about what you hope your expenditure to be then. So do you have a mortgage now? Will that be paid off? Do you have children, and do you hope that those children would have blown the nest and be dependent by then? They tend to be people's most expensive things today. So if they're gone, then what does your expenditure look like? You've got your bills. You're always going to have council tax, you're always going to have to pay for electricity, and you're always going to have to put food on the table. So they are sort of your essentials. So do a quick tally up of what your essentials will look like. And then you can start building on top of that your luxuries. So that's going to be your round the world cruises, or your holiday home in Spain, or whatever it may be. They're going to be your luxuries. So when you add the two together, you can start to pull together a figure, and that becomes your target. Once you've got your target, you can then start thinking about how you reach the target. And there are so many tools available to you. So of course there's financial advisors, and financial advisors have lots of cash flow tools that will help you put a plan in place on how to get there. But also your pension provider, they're going to have retirement calculators on their website, and they're really good because you can put in, what if I pay £100 in more today? That will be able to fast forward, and loads of free websites. So one that springs to mind is the Money Advice Service. They've got loads of help with the retirement calculators. But if you're really stuck, I do have some stats. I'm going to look down at my notes for the stats, but if you're really stuck, you just want some numbers. Everyone likes a number. Yeah. If you want to achieve 2/3 of your salary by the time you're 67, then, and you're starting out in the job market now, you're in your 20s, you're 25, you need to look to pay in about 11% and maintain that 11% from 25 all the way through to 67. If you delay it, and like all of us, you think retirement's ages away, I'm going to focus on something else, and you don't pay into your pension until you're in your 30s. Now, if you're 30, you need to pay in 16%. 35 is 21%, and if you wait until your 40s, you're going to need to look to pay in 26% of your salary.
So to put that into English, though, if you're working at, in an employer, and you're probably at least being matched by your employer,
yeah,
plus you get the tax relief, you're probably looking, for most people, we're talking about 40% of the figures you've just quoted, really, then.
Yeah. I mean, you have to remember that these contributions are the total contribution. So it's not just from you, it's from your employer. And like you said, employers, now they legally have to pay into their pension. So they had to pay at least 3%. So it's whatever's on top of that. But yeah, the later you leave it, the more you've got to pay in. So it's really important to get the figure as correct as possible, as quickly as possible, because you'll thank yourselves later on.
Yeah, my experience of it has been that, you know, that's like a mechanical strategy to achieve an outcome. I think where we've got to spend a lot of that time is on that outcome. What does that look like, and why is that so important? We've got to make that really matter so that we actually get into that habit of deferring some of our income. So we keep a little bit back, you know, and then, you know, if 15% of your income you keep for yourself and the other 85% you give that to other people, i.e. living, it's kind of a mindset thing, really. It's getting into those habits. And I found with my clients over the years that once they've done it for a while and they can see the positivity of growing their wealth, they can see they're on track, they get so motivated, they attribute the positivity to the behavior, and that behavior becomes a lifetime habit. And those are the people that make the difference. Those are the people, like I mentioned, the 19-year-old who's financially independent at age 47. Okay, so we've got to start with the end in mind, get that clear, and then you give us some guidelines as to numbers that people need to save. What's the best way to invest, and what about investing into retirement?
Yeah, so I always think there's two ways that you can influence your pension today. One is what you pay in, and we've sort of covered that bit. And the other bit is where you invest that money, because that's a really important decision, and a decision that some people think they haven't got, but you have. It's absolutely your choice as to where you invest your money. Now, your pension provider will have hundreds of funds available to them, all listed on the website. And these funds, they're different, you know, they differ from one another in one way or another. But the biggest choice that someone can make is the amount of risk they want them to expose themselves to. And by risk, I really mean investing in equity, so stock markets. Now, pensions are quite unique in the sense that they're a really long-term investment for most people. You know, for most of us, the earliest you're going to be able to touch this pension is coming into 58. So if you're just starting out in your career, this could be a 30+ year investment. Generally speaking, the longer term an investment, a person should feel comfortable taking as much risk as they're comfortable taking. That might not be much risk, but you should take as much risk as you're comfortable with the longer term an investment. The reason being, because if there's fluctuations, and you know, the past few years has been brilliant for demonstrating volatility, if there is volatility in the market, you've got the time on your side for those markets to recover. You know, we've all seen the fancy slides on the news that go up and down, up and down, up and down, but the general trend is over time, it goes up. Now, obviously, it's called risk because there is a risk that you will lose the money or you'll lose some money. So yes, the more risk you take, the more aim there is for growth, but obviously that's just an aim, that's just a target. Sorry, go on.
Yeah, I think with risk, it's, you know, I've been looking at that and talking a lot about risk recently. And, you know, there is a big risk to people not taking an investment risk.
Yeah, absolutely. Because if you don't take any level of risk, your money is sat in really cool. But there's never an investment that has zero risk. Every investment has some sort of risk. But if you take very little risk, your money's sat in cash, mainly in government bonds. And I bet no one's seen interest on their cash account for years. So actually, your money is just being eroded by inflation. So it's worth taking a level of risk. And like I say, the longer the term, you've got that time for that growth to really
You sound like a duckling.
to make a difference. And if there is a
yeah, your internet's gone very unstable again.
Markets.
Yeah, I hope that's you, not me. Yeah, so just on the inflationary risk,
I can hear you now.
Somebody gave me a good example of that the other day. Imagine you've got a large block of ice, and every time you look at it, it doesn't look any different, but it is slowly melting away. That's inflation eroding cash. You know, so that is a risk. And if you're young, you know, we should be, you know, in terms of risk is kind of confused with volatility, really, isn't it? You know, the risk of an investment is how much it goes up and down, that volatility, that movement along the journey. But the more it does and the longer you've got, then typically you get a better outcome. So it's just kind of, but the more knowledge you've got, the more information you have, the more confidence that you have. So Now, I'm conscious that we're behind a little bit, so I'm going to suggest we do overrun a little bit, so we do get all the questions covered, Caroline. If that's all right with you.
Yeah,
We've
absolutely.
got quite a few, lots of good questions coming in. I always knew that would be the case with pensions, always is, because everyone's got a pension because they got one from work. Just want to try and this old myth, that your pension dies with you, has been around for many years and hasn't quite been switched off. It needs to be. Pensions are a fantastic product nowadays for lots of reasons. But can you tell everybody the difference between an annuity and drawdown?
Yeah, absolutely. So an annuity and a drawdown are the most popular ways of drawing your pensions now. And an annuity used to be the only way you could draw sort of a defined contribution pension. But up until a few years ago, a new way was introduced called drawdown. Now, what an annuity is a guaranteed income for life. So you build up this pension pot, and then when you decide to retire, you go to the insurance market and exchange it for an annuity, which will pay you a guaranteed income for life. So the bigger your pension pot, the bigger that income's going to be. But as time has gone on, annuities have become less and less popular for two reasons. One is the annuity rates are getting worse and worse. So you have to hand over so much more money now to get the same income you would have done a few years ago. So again, I've got some stats. So if you are a man aged 65 and you've got a pension pot that's worth £100,000, back in 1990, that would have got you an annuity of £15,000. But if you're the same man aged 65 with a £100,000 pension pot in today, so 2020, that same pension pot would only buy you an income of £4,400 a year. So it's a drop of more than 2/3. So annuity rates, that really demonstrates how much they've gone down.
Is that an indication of how the insurance companies view our longevity?
Absolutely, it's because people are living a lot longer. If you think about when annuities were first set up, people retired in their 60s, maybe lived 10 or so years, and then they would die, and therefore the annuity would die with them. Now people are living so much longer, and this income has been paid out for so much longer, then that's why the annuity rates have gone down.
Brilliant. Okay, so the other thing I think that people like about the drawdown piece is obviously you have to invest into retirement. Then you're using some of that money to continue to grow into retirement, and so it's wise that people get some professional guidance and support around that. But the other thing that's very I hear a lot about is the fact that people want to pass that money on, especially if they're youngsters, especially if they want to help them with their lives, getting on the property ladder, the student debt. And so pension pots do become a big part of family wealth. And so if it's not all spent, there is money to be passed on. And some people, I understand, when they plan their retirement, they work that into their planning as well to try and maximise the amount of cash that's still in there throughout that journey. Is that your experience?
Yeah, absolutely. So one thing I said about the downside to the annuities was that the annuity rate has dropped, but the other one is they die with you. So unless you build in certain guarantees, then these annuities die with you. So when the drawdown was introduced, and what drawdown allows you to do is access your money how you want to access it. So it becomes a bit more like a savings account in a sense, because you're not exchanging it for a product. So drawdown is fantastic because it recognises that retirement has changed. If you think about if I think back to my grandparent generation, they all tend to sort of work at the same job for all their lives, full time, work on a Friday, retire on a Monday. Now it's recognising that people like to go part time or take a less stressful role. They don't want to stop working, but they don't want to work it full time all the time. So drawdown allows you to top up that loss of income, and crucially, like you've already said, it doesn't die with you. So it now is becoming much more part of your pension, your whole money account, as opposed to just for your retirement. Yes, pensions are great and they are geared up for retirement, but once you're actually accessing that money, it's yours to do what you want with it. And yes, if you pass away, then that money that you haven't spent remains in your estate, so passes to partners, children, whoever.
Brilliant. So there is another $1 million question that we get all the time, everywhere we go, and that is, what's best, pension or ISA? What's your thoughts on that?
Well, my answer is going to be you should have both if you can. But yeah, they're often compared because they've got tax efficiencies linked to them. So I often get say, how should I allocate my money? And of course, the ideal is that you have both. But if you're thinking, I can't pay into both, it's one or the other, then it's all about what that money is for. Now, ISAs, instant savings account. So the money is accessible instantly. So if you're saving for a house, then that's going to be the place to go, because or hopefully you want to try and buy your house before your 50s and 60s. So that's one of the benefits to an ISA. The other difference is the allowances. So ISAs, you have an annual allowance of £20,000 a year. With pensions, it's higher, it's £40,000 or 100% of your earnings, which is the one it applies to you. But the crucial difference is the tax efficiencies and the order in which the tax is taken. So with pensions, you get all your tax efficiencies or tax savings at the beginning. So you get tax relief on the money that you pay into your pension, any growth you get from that pension grows tax-free, and then you pay tax when you come to draw it out. So crucially, more is invested initially. With an ISA, you're taxed on your money today, so less is invested initially. You get tax-free on the growth, and you get to draw it tax-free. But from a how do I get more money invested? It's going to be pensions, because you get your tax efficiencies today. So it's all about what the money's for, and then what's going to get you more money invested, which ultimately will be pensions, because you don't pay tax till the end.
Yeah, I noticed in the UK there's kind of an obsession with people do ISAs because, and the big question is, why have you done an ISA? They do it because of tax, it grows tax free. But then the vast majority of people are in the cash ISA, not in the what they call the stocks and shares ISA. And I'm convinced that the reason for that is because it feels from an uninformed investor's perspective, cash feels safe, stocks and shares sounds scary. And so therefore they invest in there for tax reasons, but they're invested in cash. And cash doesn't grow very much. It's not grown very much for a decade. And so therefore the tax relief benefits are not really there. And I think, I think that people should think about their ISA investments, as long as it's 5 years or more, they should think of it a bit like their pension. The pensions are usually in some kind of diversified, managed or passive fund that's got a lot of stocks and shares, element in there. They should view the ISA the same. And the stocks and shares is a piece of language which is a bit scary, and maybe people should think about the ISA as an investment ISA rather than a stocks and shares ISA. It's just language. But to have the two things running together, but one in cash and one in a fund which is growing, I see it all the time. And so I just wanted to sort of put that one out there for anyone that's thinking of that. It's about, we need to get that money working for us. If we don't, it's like that block of ice that even if it does grow tax-free, it's still a block of ice which is melting slowly.
Yeah, it's a really good analogy. And there's loads of other ISAs as well out there. So there's lifetime ISAs, which are geared up for either buying your first property or getting or retirement, one or the other, and you get government bonuses from them. There's junior ISAs. So yeah, I think a lot of people, the first ISA they set up is a cash ISA, because you set it up, when you're at a high street bank with your mum and dad, setting yourself one up. So, but there's loads out there, so it's definitely worth exploring the one that's right for you.
So just as soon as you've mentioned it, this is retirement planning. And I think retirement planning is not all just about pensions anymore. When we get to retirement, we're going to have various different retirement income sources. We're going to have the state pension possibly as well. That might still be around for some of us. We might have other investments. We might have ISAs, might have some stocks and shares, we might have some cash. We might take some money from out of our property through equity release. And we might have a number of pensions. So what happens is we end up in a place where we've got multiple retirement income sources. We also have this newfound freedom where we can take the money from 10 years before our state pension age. We can take it all if we want to. We've got the freedom to take as much or as little as we like. That comes with it risk, i.e. we don't want to run out of money too soon. So what has happened is a lot freer, but it is a lot more complex. And we need to try to, and I think what I would always encourage people to do is to don't try to do it on your own. When you get closer to retirement, when it's imminent, get some professional guidance, whatever you do. If you can't afford an advisor, maybe go talk to the pension wise. There's guidance there. And a lot of people don't realise that if they put off by fees for advisors, then what they can do, a lot of pensions will allow the advice fee to come out of the pension. It's a feature called advisor charging. So rather than write a check out, you can actually have it coming out of the pot if you want to. So that's available in most cases for most people, but they just don't know about it, If somebody wanted to get some advice, Caroline, do you know where they could go to find an advisor?
Yeah, there's some great websites out there. So there's unbiased.com, vouched for. So these are all advisors that are accredited and have recommendations and things. So yeah, there's some good websites out there that can put some names forward for you.
So unbiased.co.uk
Yeah.
and vouched for.
Yeah.
Great. Okay, brilliant. Right, so I'm just going to screen share again because I need to keep their compliance people happy. I need to show the caveat slide. So if I do that now, there we go. I'm just going to, so this is now the end of the half an hour, the formal half an hour. I've got lots and lots of questions to go through, so we'll see how we get on. Thanks for joining us. For those of you who've got to go, thanks for joining. I'm sorry about the technical glitch earlier, but it didn't seem to put anybody off, so that's good news. Thanks for joining. Please, please, please give us your feedback, because what we do need to know is, what do you want to know about? What topics, what subjects, what do you want us to put into future sessions? And also, you know, if there's enough positive feedback, then we'll do some more sessions each quarter. You know, we'd sort of decide, shall we carry this on? We designed it and built it originally as a kind of a lockdown training course for people. We copied that Joe Wicks concept, just turned it into finance. So thanks very much for those of you that that have done the first half an hour. Those of you that are staying around for the questions, brilliant. So we're now past that. So I'm going to stop screen sharing again. Nobody's dropped off, so everyone's still here, which is great. So no pressure now, because now, Caroline, you don't know what questions are coming.
No, I'm off script now. Be nice, everybody.
So this is a very, very common one. I'm going to put this one out there. While you're answering it, I can look at the other questions. So somebody's got a number of different pensions they've collected over time through having numerous jobs. Would they be better off leaving them where they are, or should they consider consolidation?
So there's a couple of things to think about when merging your pensions. So first of all, the type of pension that it is. So we've spoken a lot, Darren, about defined contribution pensions, but some people will have a final salary or sometimes known as defined benefit. So they're sort of a different kettle of fish. With regards to merging them together, one thing to consider is the annual management charge of your pension. So every pension out there has a charging structure, and they're all different because it depends on the size of the company and the size of the contribution. They could range from 0.75% all the way down to 0.1%, so big difference. From a financial perspective, it makes sense to merge them all into one pension, or the cheapest pension, it's got the cheapest charge. And that might not be the pension you're paying into now, so it could be that you have a previous employer's pension with a lower annual management charge. It might make sense to put them in there, so you still have to pay into the one that your employer is paying into. So the charging structure is one thing to consider. The other thing to consider is whether you want all your money in one pension pot. Some people like it spread across various providers, different funds, etc. That's down to your choice. And if anyone's out there lost any pensions, or think, well, I had a pension a few years ago, I don't know where it is. There's a fantastic website called the Pension Tracing Service. You pop in your national insurance number, and it will list up the company. Sorry, you put in your employment dates. I was employed at this company for this date, and it will bring up the pension provider that was available to you. So you had the pension was with Aviva. You can then call up Aviva, give them your national insurance number, and then they'll be able to trace your pension.
Brilliant, thank you very much. I've got so many questions. And they're all good questions. There's somebody just done some maths. They've just said that the £140 a month for an 18-year-old is not going to do the million. But what is in there also is that we've taken an inflation, because £140, people get pay rises. So each year that proportionately goes up. So it goes up 2.5%. And we've looked at a 7% growth rate, which is about what it has done over the last sort of 10 or 20 years. But we're not allowed to take past performance for the future and all that stuff. But bottom line is, you know, this is all open to conjecture, of course. And retirement planning is not precise. We've got to kind of set the goal and aim towards it and just keep on top of it. We've got to keep monitoring and tweaking and adjusting. You know, it's never a straight line to the outcome. But yeah, we did factor in growth and inflation in there. So that's just to clear that one up for somebody. Another good one here. Somebody said, if you're late to the party, how can you make up for it?
If you're late to the party, yeah, we got a lot of that. Because, you know, it's difficult. You know, I was guilty of it myself, but my dad was a financial advisor, and he had in my ear, you know, pay into your pension. But when you're just fresh into the job market, you think you've got far more important things to spend your money on. So we're all guilty of it, but it's really important, as soon as you realise, to try and get it as correct as possible. So I gave you some of those stats earlier. Set yourself that target, work yourself backwards to reach that target. So what do you need to pay in today? And if you can't pay in what you need to pay in, then every time you try and factor in when you can pay in more. So we at Second Sight have something called Second Chance, which means that every year you sign up to increasing your pension contribution to 1%, and that's often aligned with the new tax year, so you get a little bit more in your personal allowance, or when you get a pay rise at your company. So when you do that, because you then never see the money, you sort of signed it away, you don't miss it again. So try and get as close to the amount you need to, and then get a plan in place as to how you're going to get to whatever the amount is you need to get to.
Brilliant. So there's 2 or 3 people are asking a bit more clarity around drawdown. So I'm going to try and combine the 3 questions.
Okay.
Someone's saying, look, I could take 25% tax-free cash from my pension pot, the rest is drawdown. Would the pension provider provide a payroll service effectively, or is it just cash? How do you sort out the tax of HMRC? What's the mechanics of drawdown? Let's explain it in a bit more detail.
So how drawdown works is you get your 25% tax free, or if you don't need that big lump sum at the beginning, every time you take an amount out, you can get 25% of that to that amount tax free. So for example, if you said I want to take £10,000 this year, you can take 25% of that amount tax free, so you only pay tax on 7.5. So people can be really clever with it each tax year to keep themselves in barriers and so on. So the idea is you decide how you want to do your tax, and then you get to choose what income you want to take every year, and it recognises, as I said earlier, much more flexibility. You know, I always think of my parents versus my grandparents, both retired with very different spending habits. So it recognises that you can draw more at the beginning and less later on as you're older, and the excitement of the time is sort of worn off. The money that you haven't touched remains invested. So the idea is that when you retire, you say, right, in the next 5 years, I think I'm going to need an income of whatever it may be every year. So that amount you put into a more cautious fund, because you're going to be drawing on that. You can't afford for that to fluctuate. The rest of it remains invested, and therefore people tend to expose that to a level of risk, so some equity, to try and get some growth on it. And then again, once you're getting towards the end of those 5 years, you're going to say, right, in the next 5 years, I think I'm going to need this income. You move back to a more cautious fund, and then keeping the rest of it into a level of risk.
So people would probably benefit from, when they're into their retirement and when they're spending the money they've been saving all their life, they're probably wise to get some guidance or advice, each year, I would imagine, depending on where the economy is, what their objectives are, how mobile they are, what their spending habits are like, those sort of things.
Yeah, absolutely. I mean, the thing is when you retire, no one knows when Judgment Day is coming, right? So you've got this pot of money that you've got to make last indefinitely. So yeah, it's taking it a step at a time. When you first retire, and I go back to my example of my parents, retired, and they had visions of getting their kitchen done, and it's all kind of going on all these holidays kind of stopped because of COVID, but these were their visions. So they knew what they wanted to spend each year, but if someone said, what's your spending going to be in 5 years, it would look different. So yeah, if you can afford to get in contact with an advisor, it's really helpful to get that, because they can keep an eye on the money you're not touching, try and get as much growth from that as possible, whilst maintaining a level of value, because you don't want to risk it too much. And then you can change each year as you go through your retirement as to how much you take. Brilliant.
You sort of touched on a subject which we've got a couple of people asking questions about, so I'm just going to dig a bit deeper here on this one. So the 2 questions here, one question is, does the fund continue to grow when you take drawdown? And the other question, which I think they come together really, is, do you reduce the level of risk that you're in your investment as you get closer to retirement? So I think we can kind of crunch them together and just talk about that whole thing.
Yeah, so whilst you're paying into your pension, so before you're drawing it, I said earlier that taking a level of risk whilst it's a long-term investment is beneficial, because you've got the time on your side. Now, as that time shortens, yes, it makes sense that you start de-risking yourself. For 2 reasons. One, because the time scale is getting smaller, but also your pension pot is now pretty big. You think of when you're 20, you've got a couple £100 in there. If you're going to lose some, it's not a great deal. Whereas when you're older, you've got a bigger loss. So yes, you tend to take more risk when you're younger, and you de-risk yourself as you get older. When you've actually started drawing your pension, then it's all about your appetite for risk will change, because this money is what you're living on. But also it's recognising that it could still be a long-term investment, because if you're retiring, 58, you're hoping to live another 20, 30 years, you don't need to move it all to cash today. It's all about sectioning off the amounts. And this is why, as you said, Darren, it's important to keep in touch with an advisor so you can change the level of risk you're exposing yourself to as and when you know when you need this money.
Brilliant. So there's another good question here. People just like to know some facts, and I don't know whether you've got it to hand, but and it may depend on various things. But the question is, what's a safe rate to draw down if you want to leave some cash when you die?
Oh, I don't know. I've got 4% in my head, but I don't know if that's right. I don't know. Sorry, I can't answer that off the top of my head. But
one of the ways to get the answer, because everybody is different, is to talk to an advisor that uses some kind of cash flow forecast modeling. So what you would do is you would then you'd put in what you expect to be drawing or what you need to be drawing. And that might go down as you get older because you may be less active. And you can then decide how much cash you want left over. You'll have to guess when judgment day is going to be, best guess, and then run a cash flow model to do that. And that cash flow model will tell you the drawdown rate. It might be you're drawing down more than the growth, but then that's eroding the capital. Or if the capital is growing more than what you're drawing down, then you won't. But I think everybody's different. But I think the 4% you come up with is like if you're expected to live for 20 years and it wasn't growing, it's 4%, isn't it?
Yeah. And like you said, Darren, you have to remember as well that you're not relying solely on your pensions. A lot of people say, I want an income of this in retirement. They look at all those cash flow forecasting tools and think, oh no, that doesn't look great. And then when you actually start thinking, well, actually, are you going to be drawing all this from your pensions, or do you have other savings? Then actually you start to build this picture and you can achieve it. You can achieve that target without solely relying on your pensions.
Okay, I've got 2 questions regarding advisors. So as you're an advisor, I'm not technically one anymore. They both want to know what it costs. So I think this is good because what we've done today, we've kind of encouraged people. We've given them more confidence, we've given them some more information, but I think also, it is a professional responsibility, and it's probably far too much for any ordinary person to try to manage on their own. And so professional help is definitely well worth considering. And so we're kind of moving people in their thinking and their mindset, which is great. And the reason I know we have is because I've got 2 people asking what it costs. So what does it cost if you want to engage with an advisor to get your annual meeting to plan your retirement?
Yeah, well, the first thing I would say is check what your employer offers first, because a lot of employers will offer some sort of help. So to have a look at that. But then if you want to go to an advisor, it depends on the sort of advice that you want. You can have specific advice, or you can have holistic advice. And obviously, the more advice you get, the more expensive it's going to get. You can either do it, like you said, Darren, like an advisor charging. So it's not actually writing a check because it doesn't feel like you're physically paying for it, but it takes it from the pot. And all different advisors charge different amounts. So I can't really give it will cost you X because it depends what you want. But it's worth exploring. And one thing to note as well, and I don't know we at Second Sight and Foster de Novo do it, but I'm sure most advisors do it, is they will have a chat with you. It's not the minute you pick up the phone they're going to start billing. They will have a chat with you. They will talk about your what you want from them, and then they'll be able to give you an idea of the price. So don't just think, oh, it's too expensive, I'm not engaging. It's always worth picking up the phone and finding out, because you might be pleasantly surprised. Yeah,
you can probably grab an hour for free.
Exactly, yeah, especially if you're good at chatting, because all advisors like to chat.
Well, I think the thing about financial advisors, they're primarily human beings. They like the people side of the business. That comes first before the financial side. So that's why they're there. So they are chatty old lot, aren't they? So take advantage of them. Now, that's actually come up quite a few times, that question, which that's good. That means people are kind of getting their head around the whole idea. Question here was, just a quick one. Can you transfer pensions from the EU into the UK?
Yes, you can. So there is something called Qualifying Recognised Overseas Pension Schemes, QROPs for short. And the idea is, I get asked this a lot, I'm paying into a UK pension, can I transfer it somewhere else, or vice versa? Yes, you can, but there's something to consider is that you're building up this pension in the UK
tax free, so they're not going to let you take it away tax free. And it'll probably be the same in other countries as well. I can't pretend to know the pension legislation for every single country, but it's probably similar. So yes, you can, but your pension can get eaten away heavily by tax charges and other charges. So it's whether it's worth doing it. You will never lose the money, however, so you can just keep it in the country that it's in, and then when you get to retirement age, draw it and then just convert the currency. So it's definitely worth looking at as to whether it's worth transferring it. But if you do find that it gets eaten away by costs, it will just be a case of exchanging the currency when you can draw upon it.
Brilliant. So there's a question here which I'm not going to get you to answer, but I'll just let those people know. There's a number of people have asked about the lifetime allowance and the taxation, because there is a limit. It's just over $1 million of pension pot you can have, and then you get different tax treatment of the money over and above that. There's also something called tapered annual allowance, where as you become a really big earner, the amount of money you can pay into your pension and get the full tax relief starts to come down. It comes down from 40,000 to 4,000. So I'm not going to answer those questions because it does impact the lucky few. You might not think you're lucky with extra tax bills, but you are lucky that you're earning big money and you've got a big pension pot. But we will pick that up with you guys. I've asked the question separately, no problem. So I think I've got time for one more question. Again, this is a question a lot of people ask, and I know you'll know the answer. How can I find out what state pension I will get?
Yes, so the state pension has changed a lot recently, hasn't it? So the amount of state pension you get is all linked to your national insurance contributions, so how many years you pay national insurance. And currently, to get the full state pension, you need to pay 35 years worth of national insurance. If you're not sure whether you've done that, there is a form on the government website. It's called the BR19 form. You put in all your details and that will tell you can top up. So yeah, that's how you do it. Go to the government website. It's a form called the BR19 form. It will give you a state pension forecast that's specifically yours.
So if somebody literally stuck BR19 into Google, they'd probably find their way to get their
Absolutely, yeah.
Brilliant. Right, we have officially run out of time, but we do have a lot of people still on here. There's only about 10 people dropped off from the start. So obviously that's because of you, Caroline. I'll give you credit for that. You're brilliant today. Thank you very much indeed for all of your time. I know you have to do a lot of preparation for this as well. And it's a bit nerve-wracking when you've done it for the first time. And we have technical problems. So you've done a really, really great job. And on behalf of everybody, I'd like to thank you very much. Those of you that are still on, please, please, please give us that feedback. We really do appreciate it. I'm getting quite a bit of feedback in the Q&A as well. People do want more of this, which is great. Lots of thank yous coming through there. That's good. But give us a feedback. Criticism as well. We can take it, constructive criticism. Tell us what you like and tell us what you want to learn about going forward, and if you would like us to carry on doing these things. I think the energy's there. I think we've got some momentum. I think we probably will be, but the more demand we get, then the more it's worth doing. So thanks very much from me, Darren Laverty, Second Sight. Thank you to Caroline, and have a great summer, everybody. If we're going to do it again, we'll be back in a couple of months for the summer series. Take care. Bye for now.